economic conditions in addition to an increase in government budget deficit. It means government expenses were greater than the government income. So in that case, how the government can fulfill this kind of deficit? By issuing government bonds, right? So bonds were issued in euro. So since the Greek was under, Greek is under the European Union, so there is a huge threat to those bonds which are denominated in euro. So it increased concern to other European countries as well, such as Spain, Portugal, Ireland, that had large budget deficit as well. Ireland, I think, is using pound, but Portugal and Spain still using euro. So what happened to the euro denominated bond? Their credit risk increased, their exchange rate risk also increased. Why is that? Because if the Greece government is bankrupted, then it has to pay back to its commitment of the government bond to the buyer of the bonds in euro. And what happened over there if Greek is not able to pay back its principal and interest? Its currency is depreciated, and currency is euro. So that lead concern to the many European countries. If we let that happen, then our value gonna be devalued, right? If euro is gonna be devalued, then all of the countries gonna be hit or sworn by this Greek crisis. So in order to take Greek out from this crisis, European countries and the IMF agreed to provide Greek with new loans, with new some kind of adjustments. So basically, all the European countries, they not only just save the Greek but also save themselves, right? So if they let this Greece to default, the credit risk on the euro denominated bonds will be highest, exchange rate risk going to be highest, liquidity risk was the highest. So at that time, not only the Greece, so basically the economists, they were saying that the Greek crisis is going to be the amount is going to be spread to whole European countries. And even though, like Germany also will experience the worst economic crisis if they let this Greek defaulted. So that was the link of the impact of Greek crisis on the bond, especially on those bonds which are in euro denominated bonds. And then investing in foreign stock markets. Many investors purchase stock outside of the home currency. And why is that? In order to gain more profit, right? Now we're talking about foreign stocks, which means purchasing the company stocks outside home country. Okay, so recently there is a trend that firms outside the US also have been issuing stocks more frequently in the US as well, like Alibaba listing its stocks on Nasdaq and New York Stock Exchange as well. And why is that? There are a couple of reasons. Number one is expansion. To different markets. Number two is if they float their stock, issuing the stock in the home country, then maybe not as much as people, not many people they are eligible to buy, or don't have the ability to buy, so they are going to the other markets in order to raise funds. And what kind of funds? Equity. because stocks are equity, not loan. Okay, so investing in foreign markets also give you a huge profits as well. Why? Because many companies outside the US, they are also going very well, and they are also performing well and giving you huge dividends. So you just convert your US dollar with the, for example, if you are investing Chinese company in China, you convert your dollar into yuan, and you know that in future the yuan will also appreciate. So what happened if yuan also appreciate and you receive dividend, or you want to sell your shares, when you convert yuan into your dollars, then you will receive more dollars as well, right? Because you invest in that currency who is expected to appreciate, so you will receive more dollars. And if you want a loan, you will invest in that country, or you will ask loan from that country where the currency is expected to depreciate, so that you have to pay less of your home currency, right? This is the opposite, because in one case there is payment, and in the other case there is income. So you want more income, so that's why you invest in that country where currency is expected to appreciate. And when there is a payment concern, you want to invest in that country where the currency is expected to depreciate. Okay, let's move forward. So these are the comparisons of the stock exchange as of 2008. So you see the size of market capitalization of the countries: Argentina, $57 billion. Only triple one or 111 companies are listed. Australia, look at the size. Brazil, Chile, China, Japan, Mexico, see, and United States. So, beside this United States, there are other countries. They are also growing rapidly, and investing in that countries will also give you a huge profit as well. So this is just a comparison of the countries, of the market capitalization of their listed companies. So how market characteristics vary among countries? So stock market participants and trading activities are higher in countries where managers are encouraged to make decisions that serve shareholders' interest, and where there is greater transparency. So it means those markets, if you go back to our previous slide, you will also find out that those markets who are free, who have a less influence by the government or politician, they will see higher market capitalization, higher number of listed companies onto the stock. So in that countries, other outside investor or foreigners, they also want to invest, right? So trading activity will be higher in those countries in which there is decentralized decision making, which means managers, they are encouraged to make decisions. And also where there is the manager, they also work for the benefit of the shareholders. There is no fraud or less fraud, less manipulation, and there is like a corporate governance, which is good corporate governance. Over there transparency would be higher, so over there the stock market participants will be higher, market capitalization will be higher. Many current companies, they want to list to the stock exchange, so it can be reflected from our previous slides picture as well. So factors that influence the trading activity, which means buying and selling of the stock. Number one is voting power. If you are giving voting power to the shareholders, it means you are giving them greater transparency. If the manager is bad, or director is bad, having a bad performance, then shareholders can vote against him, and can fire him, and can also appoint a new board director or director for that operations, and they can assure that he works for the shareholders so that company income grows, and also the manager bonuses also grows as well. Legal protection of the shareholders, they're going to be greater transparency to those who provide legal protection to the shareholder as well. Government enforcement of the security laws, corporate corruption, and level of financial disclosure. So these three are explanatory. The fourth and fifth one I will explain. Corporate corruption, which means that the leaders, corporate leaders or managers, they are not working for shareholder interest. They are working for their own pocket, raising their own income, their bonuses, or they are asking or they are having deals with the companies that are owned by their friends, their spouses, their relatives. And for example, the raw material company who provides raw material to the company owned by the CEO's wife. There is nothing wrong with that, but the the corruption gonna occur is that when you pay higher higher to the company which is owned by your spouse or your relative than the fair market value of other companies. For example, you there is like $10 per kg of material you are purchasing from your company which is owned by a spouse, and the same category and quality can be found by $8 per kg, and you are purchasing in tons of that material. So this kind of transaction is called corporate corruption, since it is like owned by your spouse, so you're giving them priority over shareholder interest. Level of financial disclosure. If the level of financial disclosure is higher, so investors have more information to analyze and can see that whether the company is going good or bad. It is the information provided is accurate, precise,